Well, greetings and salutations, test takers. This is the Series 7 Guru coming to you from my off-grid studio from an undisclosed location in northern Arizona. Stuck in a snowstorm here. Hopefully the infrastructure will hold up to record this podcast episode. We are in episode 6, debt securities. You know, back in the old days, we used to refer to the Series 7 as the stockbroker's exam. And I always thought that was not the right term. There are way, way more questions on bonds on Series 7 than there is stocks. So maybe we should have called it the bond broker's exam. So we'll be talking today about debt securities. And again, it's a flyover. It's a podcast that you could be listening to in the car, at the gym, wherever that may be. But I will link to the full video lectures on both corporate bonds and muni bonds. And again, if there's anything you'd like more clarification on, you can certainly in a channel search bar put in that term, and whatever content is available will come up as well. So, but I will at least link to the corporate bond full lecture and mini bond full lecture. The two major risks in buying debt securities are interest rate risk and credit risk. You know,
motion detected at front door.
Credit risk is the idea that you don't get paid back. Interest rate risk is the idea that interest rates go up and the price of your bonds go down. So, you know, credit risk, if customers concerned about credit risk, maybe of the three issuers you're held accountable for, maybe we recommend U.S. government securities. You know, in a U.S. government security, there's no risk of default. There's interest rate risk, but no risk of default, right? I joke, if you buy a AAA corporate bond, Johnson & Johnson's or Microsoft, that's AAA corporate credit quality. I mean, they could default, but you could hardly blame me for that. You know, whereas if you buy, again, a less than BBB junk bond, it's more likely they're going to default. So again, we'll be talking about both those risks. First, we want to talk about what bonds have in common. And one thing issuers always have is what's called the coupon or nominal yield. You know, the issuer says, we don't care what you paid for the bond. We're going to pay 8%. Now, it's referred to as the coupon because in the old days, you'd have a bond certificate. There'd literally be coupons attached to it. And you could clip the coupon every 6 months, take it to the appropriate instrumentality bank, paying agent, and they would give you the check. So it was an 8% bond, for example. And, you know, I had 100,000 face value. That would be 8,000 a year in annual interest. There'd be two coupons. I'd clip one. I'd turn it in. I get $4,000. Most bonds today are fully registered, but we still refer to that as a coupon rate. The nominal yield, the fixed or stated rate of return. What will they call it on your exam? You know, whatever you're not prepared for. Now, you do need to know that of all the rates that you're held accountable for, that is the rate that does not change. The other things we'll be discussing change based on what happens to interest rates in the secondary market. So the current yield. You should be prepared to do the current yield on your exam. Current yield is what an investment pays you divided by what it costs you. What a bond pays is annual interest divided by the market price. And that current yield is going to fluctuate because the secondary market price of the bond will fluctuate. You know, I always joke, if anybody ever asks you about economics, finance, investments, you want to sound smart, you should say it has a lot to do with interest rates. Now, you should be able to crunch current yield, whether it's a bond that we're discussing now or a stock. You definitely should be able to do that. Now, in terms of the other yields that are associated with a bond, you just need to know where they're at in relationship to each other, right? So the other yield we have is a yield to maturity. The fancy word for yield to maturity is basis. You know, when I buy a bond at par, all these yields are the same, right? So if I buy the bond at par, maybe as a primary transaction, I'm getting it directly from the issuer. They agree to pay me 8%, $80, 80 divided by par, 8%. Maybe it has 10 years to maturity. I buy it at par. I get back 1,000. I don't make nor lose any money by holding the bond to maturity. All I make is my 8%. Let's say it's callable in 5 years at par. Again, if it gets called at par, I don't make nor lose any money. So all those yields would be the same. Now, we would always quote yield to maturity if the bond is at par or discount. Now, the way we express this is we should quote the lowest yield the customer could expect, not the highest yield. And so you say, well, Dean, the yield to call on the bond. I said, well, yeah, but, you know, That would be higher. If it's a bond at a discount or par, that would be the highest yield. The bond that is very testable on your exam is a bond at a premium. Now, I joke about this, but when I'm offered any answer set, and one of my choices is yield to call, 90% of the time, that is going to be the correct answer. Because what they're testing on is, do you understand that if a bond is trading at a premium in the secondary market, it's because interest rates have gone down, and it's very likely the issuer is going to refinance, is going to call away, replace that high-cost debt with low-cost debt. And so I would just tell you, if you see that the answer set, try and figure out how that's the answer. Now, as I said, we call it yield to worst. So on a bond at a premium, the lowest yield, and the yield you should be expecting would be yield to call. Now, that if you find that yield to call attractive, by all means, then buy the bonds. Something somebody needs to know. Now, MSRB, the Municipal Securities Rulemaking Board, says that whenever you sell a muni bond at a premium, you must quote yield to call. So I can't imagine any draw of your Series 7 in which you're not asked about a bond at a premium. You might have to reverse engineer that with what we call the teeter-totter or seesaw. You can, in the timestamp, find the teeter-totter seesaw or have a separate lecture on it. Anyways, I have bond geeks who don't like the teeter-totter seesaw. Oh, it's not that simple. I said, well, anything I can use to turn a judgment question to an aim and shoot question, I'm a big fan of that. So, you need to recognize the bond at premium. I'm hinting that you may have to figure out which one of those bonds is trading at a premium by, on the test, giving you yields, right? I say the bond has a yield to maturity less than the nominal yield. From that, you would determine it's a premium. You did get tested on bond ratings, and the bond rating that you get tested on is Standard & Poor's. And you should definitely know that triple B is investment grade. Below triple B is less than investment grade. Now, we'll never say junk, because one man's junk is another man's treasure. But on the test, triple B is investment grade, below triple B is less than investment grade. Again, this idea of interest rate risk and credit risk. If we have a bond with less than that, investment grade credit quality, it's more likely that bond is going to default. In PS, you could diversify that away, right? I mean, you could create a high yield bond portfolio. It would be unlikely that all of your high yield bonds would default, or you could invest in a mutual fund. Whereas you cannot diversify away interest rate risk. All right, so what other debt securities? We talked about in general bonds. Let's talk about now particulars. So what are some money market securities that you're held accountable for? You are held accountable for commercial paper. You should know that commercial paper is less than 271 days or 270 days or less. You should know it's issued at a discount. And you should know it's large unsecured borrowing by corporations. You're held accountable to know the bankers' acceptances are used to facilitate foreign trade. They too are issued a discount. They too are money market securities, right? And have less than 270 days or less max maturity. Negotiable jumbo CDs, they like to use an accept format. They like to say, all the following money market securities are issued at a discount except, T-bills are issued at a discount. That would be, T-bills, by the way, would be the best money market instrument available. However, T-bills, they'll say all the following are issued at a discount except T-bills, commercial paper, bankers' acceptances, negotiable jumbo CDs. Ding, 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 ding. Negotiable jumbo CDs are a money market instrument. They're not issued at a discount. Negotiable means there's a secondary market, which kind of makes sense because, I need to be able to, if I'm a money market fund manager holding negotiable jumbo CDs, I need to perhaps be able to sell them to meet redemption requests. Jumbo means 100,000 or more. So negotiable jumbo CDs. Bonds have call provisions. So another risk that we get tested on is the what's called call risk. The idea that if interest rates go down, the bonds go up, and that sounds wonderful, except now your bonds are more likely to be called away from you. The issuer will typically grant you some call protection. The call protection consists of time and price. How long before the issuer can call the bond away from you, and at what price? Is there a prepayment penalty? For example, is it callable at 5 years at 105? The longer the time, the greater the price. the better the call protection. And again, this has that whole thing about yield to call and is there call provisions. Now, there is a way. There are some bonds that are non-callable. I would definitely know that zero coupon bonds are not callable and treasury securities are not callable. So if you want to eliminate call risk, maybe you would focus on zero coupon bonds or government securities. Exchange traded notes. Key point. Note, this is a debt security. And this is where the sponsor or distributor, typically a financial institution, agrees to pay you a return based on a referenced index. So maybe the referenced index is the S&P 500. It goes up 10%. I owe you 110 grand. The test question is the risk of default. Now, exchange traded funds are not debt securities. To just make sure you know that ETNs are debt securities, the risk of default, credit risk, ETFs are not. All right, let's talk about the various types of corporate bonds. We have various types of corporate bonds. As I said, big picture, you're held accountable for three issuers: corporate issuers of debt securities, municipal issuers of debt securities, and the U.S. government is an issuer of debt securities. Eurodollar bond. A key point here is it's issued and denominated in dollars. You know, a lot of U.S. dollars are not in the U.S. They're financing things overseas. And the point here is if I have a Eurodollar bond issued by, for example, Nestle or Heineken, those are European issuers, I don't have currency risk because I'm lending dollars. I'm being paid back in dollars. Whereas on the other hand, it's a Euro bond, missing word dollars. You know, I'm lending euros. I expect to be paid back in euros, and I do have currency risk, right? Because at some point I got to turn euros back into dollars. Eurodollar bond, again, a European issuer, denominated in dollars, and so as a U.S. holder, I don't have currency risk. Mortgage bonds, again, these are recognition-style questions on your exam. Mortgage bonds are secured by real property. Now, remember, real property means not only the building, but the underlying, real estate as well. And remember that secured bonds are senior in liquidation, right? So if we liquidate the business, the secured bondholders come first. Equipment trust certificates are secured by major movable equipment. And to be major and movable should have wheels on the bottom of it called rolling stock. These are very popular with transportation companies like airlines typically issue a lot of equipment trust certificates. Unsecured bonds. Debenture is just a full faith and credit of the corporation. I joke, the equivalent to you would be when you're borrowing money, are you pledging secure or assets as collateral for the loan, like your mortgage? You're pledging the real property, the house and the real estate. Your car loan, you're pledging the car, right? You don't pay it, then they come get it, right? The equivalent of your, debenture would be your Visa. The only thing that backs that up is your promise to pay. Now, we probably all have a credit card in our pocket, and it's unsecured. And if our promise to pay in the past has been good, we can borrow lots of money and pay little for it. If our promise to pay in the past has not been so good, we probably still have a credit card, but it's going to have, a lower credit line and higher interest rate, right? So that would be the equivalent for a corporation. We have zero coupon bonds. I can't imagine that you don't get a draw. I'm wishing for you a dream draw on your Series 7, but you got to be prepared for a face of death draw. And again, it's about probabilities. And, angels weep for you if we tell you to expect questions on certain topics and then you get that question, you can't perform on it. Zero coupon bonds. Remember earlier I told you that in the old days, bonds had coupons, income payments, and you would clip those coupons and take them to the appropriate instrumentality for payment, a bank, paying agent. And we don't do that anymore. Most bonds today are fully registered, and they send you the appropriate checks at the appropriate time. So we still refer to that as a coupon. So zero coupon means no income stream, no income payment, no interest payment. So at a zero coupon bond, you're buying these at a steep discount, and you're holding them to maturity. Now, and what you'd like to tell the IRS is that that's a long-term capital gain because you held it for more than 1 year. The IRS says no. That at a zero coupon bond, there's imputed interest you're receiving. So you have to do straight line amortization upward called accretion, and you have to pay taxes on that. Now, understanding that that imputed accreted thing, the accreted amount is taxable, is very testable. I don't think you're going to have to compute that, right? I don't think you're going to have to say, okay, it's $500, $1,500 divided. I don't think you're going to have to do that. But you do have to have a general understanding of that. Test question number 2, they're non-callable. So you don't have any call risk in a zero coupon bond. And then test question number 3, they're very good for somebody who needs a set sum of money at some future date. You know, for example, I was at a baby shower and I said, I've got the kid 20 grand when she starts college. And so what I bought was a zero coupon bond that matures for 20 grand, 18 years from today. We also have convertible bonds where the issuer says, listen, you can convert this into our common stock. So we're going to, at the end of the term, going to ask, do you want $1,000 or do you want X number of shares? It's very important when the issuer does it, they set these specifications at issuance. And one of those things is what's called the conversion price. It's very important as a test taker that you know you can't do anything with a conversion price, that you have to establish a conversion ratio. So when given the conversion price, you need to establish the conversion ratio. I joke, when you're doing a convertible question, they say conversion price, you got to go, bastards. I don't need the conversion price. Let me right now reset to par, get parity. I'm back in business. You have to be able to calculate parity, at least one question, maybe 2 on your test on parity. You can't be fumbling around with that. Now, I will link in the video description to a video on just convertible bonds. You know, parity, we're going to take the current market price of the convertible, divide by the conversion ratio, number of shares, and then we would get parity of the common. To get parity of the bond, we would take the current market price of the stock, times it by the number of shares, and we would get the parity of the bond. Now, there might be an arbitrage opportunity between those two prices. Only in Series 7 fantasy land will you discover arbitrage opportunities. Arbitrage opportunities are profiting from price discrepancies. Totally legal. But, you know, one thing I could do is if I notice on the test, as I said, only in Series 7 fantasy land are there arbitrage opportunities. If you see this in the real world, call me. I joke. At least when you guys pass, you get to leave Series 7 fantasy land. I'm stuck here permanently. No wonder I'm demented. But in other words, if I discover that the bond is trading for less than parity, there's an arbitrage opportunity. I can borrow the stock, sell it short, buy the bonds, turn them into common stock, cover the short position. I went pretty quickly there, but I'm just illustrating that arbitrage, riskless arbitrage is where you go long and short at the same time. I wouldn't, you know, it's a podcast episode. I'm not getting too in the weeds here on convertibles with you, but just heads up, arbitrage test question is profiting from price discrepancies, and it might involve a short sale. So not all short sales are about profiting from declining stock price. Another reason to do a short sale would be to engage in arbitrage. All right, well, high yield bonds, we said, are less than investment grade, less than BBB. And, you know, we do have, a way to diversify that risk. For example, maybe you buy the Franklin Age High Income Fund. You know, it has junk bonds in there. We don't call it the junk bond fund, right? So here you would get your yield up. Again, my main point is in the lower the credit quality of the bond, the more the risk of default. And the second point is you can't diversify away interest rate risk, but you can diversify away default risk. Income bonds or adjustment bonds are very testable. Income or adjustment bonds only pay interest when and if earned. When and if earned. They're used in bankruptcies and restructurings, and they have trade flat. Trade flat means no calculation of accrued interest. And so I would know that income or adjustment bonds trade flat, no calculation of accrued interest. They pay interest when and if earned. You know, bonds in default trade flat. So that's what that term means, and I would be prepared for that. Kind of one of those weird questions. All right, types of muni bonds. You have two types of muni bonds. And the two types of muni bonds we're going to be discussing. Again, it's a podcast episode. I will link to the muni bond lecture in both the video description and a pinned comment. But one thing you do get tested on municipal bonds is the legal opinion. The legal opinion is generated by the bond counsel. You definitely need to know who does it. You definitely need to know that legal opinion is going to be either unqualified without reservation, and that's good, or qualified with reservations, that's bad. And what the bond counsel is opining about in the legal opinion is they have the legislative authority to borrow the money, that the bonds are federally tax exempt, and the muni bonds don't have to comply with 33, the Prospectus Paper Act, right? So we don't use prospectuses when selling muni bonds. We use what are called the official statement. The official statement is the prospectus equivalent in muni bonds. As we said, there's two types of muni bonds. There's GO bonds and there are revenue bonds. And, listen, you got to do your own work. I had somebody today ask me, do I have a sheet of paper folded in half with all the terms of GOs on one side and all the terms on revenues on the other? And the answer is no. I had suggested in the video lecture that you do that. Take a piece of paper, fold it in half, and on one side write all the terms associated with GO bonds and all the associated with revenue bonds, because that's a big part of the exam, is distinguishing between GOs and revenues. They like to say all the following are associated with GOs except, or all the following are accepted with revenues except, or which of the following is true of GOs, or which of the following is true of revenues. So a big thing. Now, I do have a tutoring replay, and you can put that in there, and maybe it'll pop up. We're in a tutoring session. We did take the whiteboard and fold it in half, and I think we did quite a bit of that. But, got to do your own work. But I certainly would recommend you do that. In revenue bonds, GO bonds, we know is voter approval, taxing authority, that kind of thing. In a revenue bond, before we issue, we're going to have a feasibility study. So feasibility study is associated with a revenue bond. And we're going to have a bond indenture. That's a contract between the issuer and the trustee for the benefit of the bondholder. And one of the things that we get tested on is what's called the flow of funds. We would always assume on the test net revenue pledge. And the test question is to know that in a net revenue pledge flow of funds, the operation and maintenance fund has priority. So review a couple potential test questions. Net revenue pledge, operation and maintenance fund has priority. And the flow of funds, where do you find the flow of funds? In the bond indenture. Now, some muni bonds have credit enhancement, where there's an insurance company that says if the issuer defaults, the insurance company will continue to pay you the timely payment of interest and principal. And again, the test question here is that, some are, some are not, and what they do and they don't insure. They don't insure the secondary market price of the bond. What they insure is that you will continue to receive the timely payment of interest and principal at maturity. We do get tested on TANs, RANs, TRANs, and BANs, tax anticipation notes, revenue anticipation notes, tax and revenue anticipation notes, and bond anticipation notes. These are a way for the municipality to even out their cash flow. So they're anticipating some taxes. They like a cash advance against that. Again, a muni equivalent borrowing against receivables are anticipating some revenue, some taxes and revenue. Bond anticipation note you would get from your underwriter. So the municipality says, hey, you're underwriting these $1 billion in GO bonds for me. Can we, the municipality, the issuer, have a $200 million cash advance? I, as your underwriter, say no problem. Of course, when I sell the bonds, then I'm going to want back my $200 million and a little interest. Some muni bonds have put options where you can put the bond back to the issuer. This would be really terrific in a rising interest rate environment, where they say at the end of 5 years, the bond becomes puttable. So call provision is advantageous to the issuer in a falling interest rate environment, and a put provision is advantageous to the bondholder in a rising interest rate environment. We do get tested on accrued interest, and you can imagine what a mess the securities industry would be if everybody's doing it differently. So, if I'm selling you my bonds, I say, listen, you're going to get a check on July 1st and not all of that money belongs to you. These were my bonds for all of January, part of February. And you say, well, Dean, when I get the check, I'll send you your pro rata share. I said, listen, this is a transaction, not a relationship. Why don't we right now figure out how much of that money belongs to me? So accrued interest, test question number 1, is paid by the buyer to the seller. So besides the price you've agreed to pay for the bond as a buyer, you also have to pay the seller that dollar amount of the accrued interest. Test question number 2, the accrued interest is calculated from the last interest payment date up to but not including the settlement date. Test question number 3, regular way settlement for corporates and munis is T plus 2, and we use a 30-day month. We didn't want our high talent men and women to have to remember nursery rhymes and knuckle humps about how many days have September. So under Uniform Practice Code, corporates and munis have 30-day months, and they trade T plus 2. Now, U.S. government securities are goofy, for accrued interest. They settle T plus 1, and they use an actual calendar. So make sure you know that distinction. On munis, corporates and munis, but primarily munis, in determining suitability, we are going to get tested on taxable equivalent yield and tax-free equivalent yield. Does my customer, when he gets 8% taxable, after he pays his taxes, what's he left with? So we can make a fair comparison to whether the muni is the better route or not. By the way, that taxable to tax-free is going to be a lower number, right? And that lower number we would compare to the muni. Or if we get a muni and we're not paying taxes, what is the equivalent of a taxable bond? I would imagine you're going to have to do this on your exam. Again, this is a podcast episode. I'm not going to get a whiteboard now and show you how to do this, even though you need to be able to do it. I would refer you back to the appropriate lectures. For an overview, the taxable equivalent yield is going to be the taxable yield multiplied by 1 or 100% minus the tax bracket. And the tax equivalent would be tax-free divided by 1 or 100% minus the tax bracket. There's things you can't be fumbling around. Calculating parity is one of them. This is another. So, there's not a lot of math on Series 7, but the math is there. You can't be fumbling around with how to do it. There are some bonds to certain taxpayers, AMT bonds. The alternative minimum tax is when you make a couple $100,000 or more. If you make a couple $100,000 or more a year and you start taking your deductions, when you're all done, it looks like, you're going to get a refund. We say, no. Try it again using this alternative method. And by using this alternative method, everybody's going to owe some kind of tax, going to have some kind of a tax liability. So when you're doing the alternative method, they have what are called preference items, things that previous to this calculation you could use to reduce your tax exposure, like industrial development agency bonds, like stadium bonds. But if you're subject to the AMT, no. If you're subject to the alternative minimum tax, then the IRS calls industrial development agency bonds private activity bonds, and they become taxable. And the IRS calls a stadium public purpose, not essential. I mean, it's not essential that 50,000 of us get to bond over the Raiders losing another football game. So that's a public purpose, but it's not like building a high school. So before I sell you those bonds, I say, are you subject to the EMT? It's a binary suitability question, yes or no. If the answer is yes, and then you shouldn't buy these bonds. By the way, if the answer is no, then it doesn't matter. All right, the last issue I told you you're held accountable for is the U.S. government. The U.S. government issues T-bills, T-notes, and T-bonds. You should definitely know that T-bills are issued at a discount and trade kind of funky as a discount from face value. The way they are quoted is a little bit different as compared to other things. I'll leave it to you, and you can check out, put that into my channel search bar, and it'll come up. I would know that T-notes and T-bonds, unlike corporates and munis, which trade in eighths. So if I work the bond desk and I buy munis or corporate bonds into our inventory, sell them out of our inventory, all debt securities trade over the counter in a negotiated quote-driven market. That's testable to know that over-the-counter markets are negotiated quote-driven markets. The difference between my bid and my offer, my minimum spread in corporates and munis is going to be an eighth. But in treasuries, it's going to be 30 seconds. So T-notes and T-bonds, what I know is they're goofy. They're goofy and that they settle T+1. They're goofy and that they use an actual calendar, and they're goofy and that they trade in 30 seconds. Government-sponsored agencies, the one you're going to get tested on here is Ginnie Mae. You definitely need to know that Ginnie Mae is the only debt security that pays interest and principal monthly, right? It has the full faith and credit of the United States Treasury, and, right, full faith and credit, it's fully taxable. So it pays interest and principal monthly, has the full faith and credit of the U.S. Treasury, and it's fully taxable. So whenever you have three of a thing, be careful for the except format. All of them are true of Ginnie Mae except. Fannie Mae and Freddie Mac are pretty similar, but they don't pay interest and principal monthly, and they don't have the full faith and credit of the United States Treasury. They don't have a direct, guarantee of the U.S. Treasury. These are called mortgage securities. I'll leave it to you. Again, it's a podcast episode. But when I buy Ginnie Mae, what I'm buying into is a proportion ownership in a pool of mortgages. And if you and I put the same money into the same mortgage pool, our checks would look exactly like. Boring. So what I might want to do is buy the whole Ginnie Mae mortgage pool and carve it up into various cascading cash flows. Whether I do that with a Ginnie Mae pool and call it a CMO, collateralized mortgage obligations, where I've now carved the mortgage pool into various cascading cash flows. That's more fun, right? And I say, listen, you can have the early cash flows, you can have the later cash flows, or whether I do it with bonds or credit card receivables or cars, car loans, whatever the case may be. Now on CMOs, the two tranches, we give something a fancy French name, we can charge more for it. Not getting much for snails with butter, but escargot and brewing, now we're talking. Tranche is the French word for slice. And so I say, if you own the plan amortization classes, the early tranches, you're going to have more predictability and lower risk because, again, people don't typically refinance their mortgage right out of the gate. Whereas if you buy the later cascading cash flows, and again, I'll link to an entire video lecture on CMOs and CDOs. But if you buy those later cash flows, you're going to have less predictability and more risk. We never test you on reward. It's always, risk. But those will be called the TACs, the targeted amortization classes. So you will get a question. Most vendors go overboard on tranches, but, you will get, this idea of PACs and TACs and suitability. All right. So I think that concludes this episode. So next episode is episode 7. And I think what we're going to be doing, we're continuing to do this in the reverse order of waiting on the test. And that next episode will be customer accounts. Very testable. And remember, inch by inch, your Series 7 is a cinch, yard by yard. Your Series 7 is hard. I'll see you for the next episode. I'm trying to bring these in at 30 minutes, so I apologize if I'm going a little quick, but, we're trying to make podcast episodes, not my corporate and muni bond lecture and all that are hours a piece, right? So also, this is the second episode I'm doing from my off-grid location. I'd be interested in knowing what you think of the audio and video quality. I've got most of the infrastructure here off-grid, and I'm just wondering how it compares to my studio in fabulous Las Vegas and whether I should, in my own programming, plan on doing more things here or just keep things in the studio. So I'd appreciate your input on that, and I'll see you for the next episode. Bye-bye.